Welcome back to Brainy Bytes. Ready to absorb the knowledge that fuels top performers and makes you the sharpest mind in the room? They say the average CEO reads a book a week. Imagine having that power distilled for you. Stick with us for today's life-changing insights and hit subscribe and the bell so you never miss the wisdom to reach your peak potential. The Intelligent Investor. Benjamin Graham. Full summary. Is investing in the stock market just a form of sophisticated gambling? Or is there a rational, time-tested approach to building wealth safely and steadily without succumbing to market madness? Benjamin Graham, widely hailed as the father of value investing and mentor to legendary figures like Warren Buffett, laid out just such a framework in his masterpiece, The Intelligent Investor. It's considered by many to be the definitive guide to navigating the market with wisdom and discipline. Introduction. Today we delve into Benjamin Graham's The Intelligent Investor, first published in 1949 but continuously updated with commentary, most notably by Jason Zweig in recent editions, keeping its principles relevant. Graham's core message is profound. Successful investing isn't about having a genius IQ predicting the future or complex strategies. It's primarily about establishing a sound intellectual framework for making decisions and developing the emotional discipline to avoid common errors. This book defines what it means to be an intelligent investor. Someone who focuses on rational analysis, risk management, and long-term value, rather than market fads or emotional reactions. This summary will cover Graham's foundational philosophy and the practical approaches he outlines for different types of investors. Core philosophy and foundational concepts. Graham builds his investment philosophy on several crucial concepts. Number 1. Investor versus speculator. Graham draws a sharp distinction. An investor is someone who, through thorough analysis, seeks safety of principle and an adequate, not necessarily extraordinary, return. A speculator, on the other hand, primarily bets on price movements without that rigorous analysis or focus on principal safety. Graham writes exclusively for the investor. Speculation is a different game, often a losing one for most people. Knowing which you are is the first step. Number 2, meet Mr. Market. This is Graham's brilliant allegory. Imagine you have a business partner named Mr. Market. Every day he shows up and offers to buy your share of the business or sell you his, often at wildly fluctuating prices based on his manic depressive moods. Some days he's euphoric and quotes high prices. Other days he's despondent and offers low prices. The intelligent investor understands Mr. Market is there to serve you, not guide you. You are free to ignore his daily offers entirely. You only engage with him when his mood offers you a clear opportunity, buying from him when he's irrationally pessimistic, low prices, and potentially selling to him when he's wildly optimistic, high prices. Crucially, you never let Mr. Market's moods dictate your own emotions or decisions about the underlying value of the business. Number 3. The margin of safety. This is the absolute cornerstone of Graham's philosophy, the central concept of value investing. The margin of safety means only buying a security when its market price is significantly below your conservative estimate of its intrinsic value. Intrinsic value is based on the company's assets, earnings power, and future prospects, determined through careful analysis. This difference between the calculated value and the lower price you pay acts as a crucial buffer. It protects you against errors in your own analysis, unforeseen negative events, or simply bad luck. The wider the margin of safety, the lower your risk of significant loss. Always demand a margin of safety is Graham's prime directive. Number 4. Price is what you pay. Value is what you get. Following from the margin of safety, Graham constantly emphasizes the difference between a security's fluctuating market price and its underlying intrinsic value. The intelligent investor focuses on identifying and buying businesses when their price is demonstrably less than their value. They are not swayed by market popularity or price momentum alone. Number 5. Temperament over intellect. Graham observed that high intelligence doesn't guarantee investment success. More important is temperament, emotional discipline, patience, rationality, and the ability to resist crowd psychology. Controlling your own emotions, particularly fear and greed, and thinking independently are paramount. The intelligent investor doesn't follow the herd. Investment approaches, defensive versus enterprising. Graham recognized that not all investors have the same time, skill, or inclination. He outlines 2 main approaches. Number 1, the defensive investor. This investor's primary goals are safety of principle and freedom from effort, annoyance, and the need for frequent decisions. Their strategy should be simple and largely passive. Graham suggests a balanced portfolio, often around a 50-50 split between high-quality bonds and a diversified portfolio of leading stocks. For stocks, this could mean owning shares in large, prominent, conservatively financed companies with long records of dividend payments, or more simply today, investing in a low-cost, broad stock market index fund. The defensive investor uses dollar-cost averaging, investing fixed amounts regularly, rebalances periodically, e.g. annually, to maintain the desired stock or bond allocation, and generally avoids trying to pick individual stocks beyond simple diversification. Number 2, the enterprising investor. Also called the active or aggressive investor. This individual is willing to devote significantly more time and effort to research and analysis in the hope of achieving better than average returns, while still adhering strictly to value principles and margin of safety. Graham outlined several potential areas for the enterprising investor, such as buying unpopular large companies when they are temporarily out of favor, carefully analyzing secondary or smaller companies if a sufficient margin of safety exists, or exploring special situations like mergers or liquidations. However, Graham repeatedly warns that this path requires considerably more knowledge, skill, and diligence, and that consistently beating the market is extremely difficult, even for professionals. The enterprising approach is not for everyone. Application: becoming an intelligent investor. How do you put Benjamin Graham's timeless wisdom into practice? Number 1, define yourself, period. Honestly determine if you are an investor or speculator. If an investor, decide if you have the time, skill, and temperament for the enterprising approach, or if the defensive approach is more suitable. Self-knowledge is key.
Brainy Bytes.
Number 2, use Mr. Market. Don't be led by him. Treat market fluctuations as opportunities, not dictates. Buy when prices are unreasonably low, panic. Potentially sell when unreasonably high, euphoria. And ignore him the rest of the time. Number 3, always demand a margin of safety. Make this non-negotiable. Only purchase securities when the price offers a significant discount to your conservative estimate of intrinsic value. This is your primary defense against loss. Number 4, focus on long-term value. Concentrate on the underlying business quality and value, not short-term price movements or market forecasts. Think like a business owner. Number 5, master your emotions. Cultivate patience, discipline, and rational detachment. Avoid acting on fear or greed. Develop independent judgment. Number 6, keep it simple, especially if defensive. Complexity often increases risk and reduces returns. Stick to straightforward strategies you understand. I hope this deep dive into Benjamin Graham's The Intelligent Investor provides a solid foundation for a rational approach to investing. If it did, please show some love by hitting like and subscribe to join our Brainy Bytes community for more summaries of foundational books. Want to help fuel future content like this? You can support the channel by buying me a coffee through the link below. It helps me dedicate more time to finding and summarizing these impactful books for you all. And speaking of impactful ideas, what classic book on investing, finance, or decision-making should I explore next? Let me know your suggestions in the comments. Your input drives the channel. Thanks for watching.